Hello friends, welcome to Yadnya Investment Academy. Today we will see or we will analyze a fund. The fund name is Nifty 50 Value 20 Index Exchange Traded Fund. This fund has been launched by three AMCs, Reliance, ICICI and Kotak. What we feel, though the history for this particular fund is very less, hardly three and a half years history is available. But we feel that this particular fund should always be on your radar if you want to allocate your money in large cap funds. So, though this fund has not been covered in all over the mutual fund industry, but we still feel that this is one of the top quartile large cap fund, and you should always have some kind of allocation in this particular fund. So we'll start the analysis part. How this fund, this particular index, because this is an index. National Stock Exchange has developed this index. How they have invented this index? It is a diversified portfolio. It is a portfolio of most liquid 20 value blue chip companies. These companies they have chosen from Nifty 50 index. So these are the top or most liquid scripts which are available. The selection criteria was like this. The return on capital employed should be on a higher side. The price to earnings ratio should be on a lower side. Price to book ratio should also be on a lower side, and dividend yield should be on a higher side. So in these four particular criteria, what they have done, they have given some weightages to different criteria. Like return on capital employed is enjoying 40% weightage in this selection. Price to earnings ratio means low price to earnings ratio is having 30% allocation. Then low price to book ratio is having 20% allocation, and dividend yield is having around 10% allocation. So after calculating everything for each and every script on the Nifty 50 index, what they have given, they have come out with a rank, and according to the rank they have given allocations to different stocks. So there is a capping of 15% individual to individual stock, but this rebalancing and all those things would be done on an annual basis. So the total number of companies are 20. This particular index was launched on 28th of March 2014. But the base date for calculations, all those things, they have taken a backdated date. So that date is 1st Jan 2009. So base value which they have fixed on 1st Jan 2009 was 1000. And current value of this index, NV20 index, Nifty 50 NV20 index is 5141. Every day we get the value of this particular index. We get it on NSE website also, or you can go and search on Google also, you will get that. The index rebalancing will be done on annual basis, particularly after last month's, means calendar year's last expiry date. The index would be rebalanced, and in that particular thing 15% is the maximum allocation one particular stock can get. But in between, if in that particular year, if that allocation goes above 15%, then the rebalancing will not happen. The rebalancing will be happening strictly on end of the calendar year. So now in current scenario, these are the 20 companies where this particular index, these companies are constituting the index. So you can see that Infosys is around 14.82% allocation in this particular index. Then Reliance is having 13.63%, ICICI Bank is having 12.98%, TCS is having 11.80%, HUL is having 6.59%. Now in the case of HUL, you will say that the price to earnings ratio and price to book ratio is very high. Then how come this particular stock is available in this particular index? The main reason behind this is the high return on capital employed. HOL is enjoying more than 150% of the return on capital employed, and ROC is having 40% allocation or weightage in the selection criteria, and that is the main reason why we are seeing HOL in this particular index. Then SBI is having 6%, Axis Bank is having 5.87%, HCL Technologies is having 3.33% allocation, then NTPC 2.84, Tech Mahindra 2.65, ONGC 2.46, Tata Steel 2.37, Wipro 2.13%, Coal India 2.07%, Hero MotoCorp 2.05%, Bajaj Auto 1.99%, Yes Bank 1.97%, GAIL is having 1.92%, BPCL 1.23% and HPCL 0.95%. So in all these 20 companies, the highest P ratio HOL is enjoying, but rest all companies are trading at less than 20 price to earnings ratio. Though currently ICICI Bank P ratio is looking at 66-67, that is majorly because ICICI Bank is coming from losses into profits, and that is the main reason that the denominator is on a lower side. But if you look at the historical things, ICICI Bank is also trading between, if we look at the forward earnings, so it is not trading more than 14-15 kind of price to earnings ratio. So this is the current portfolio of this particular Nifty value 20 index. Then as you have seen the companies now, the sector allocation you can see, information technology is having 34.87% weightage, financial services is having 26.91% weightage, energy companies are having 23.10% allocation, consumer goods 6.61%, metals 4.46% and automobile 4.06%. These are the top 6 sectors where the allocations are happening. So almost I think they are covering everything in these sectors. So the average portfolio's average price to book ratio is 2.62% and portfolio's average price to earnings ratio is 20.39%. So you can see Nifty 50 indices price to earnings ratio is more than 25-26. But this particular portfolio of top 20 value blue chip companies is 20.39%. In this also majorly ICICI is having more, is showing more price to earnings ratio. So after, I think if we look at the forward P ratio, I think this particular index is trading between 16 to 17 price to earnings ratio. So the portfolio is very attractive. You can say that traditional kind of portfolio, we can see no particularly high growth companies you are looking in this particular portfolio. Not even HDFC Bank or HDFC Limited or Bajaj Finance, these companies are not available in this particular portfolio. The interesting part about returns, in last 1 year when you see the indices are almost flat, this particular index has given a return of 11.62%. The 3 years CAGR is 14.84%, 5 years CAGR is 13.90%, and since inception means 1st Jan 2009, this particular index has given returns of 20.12%. So almost on all parameters, these returns are looking good. The expectation from large cap kind of category should not be more than 12 to 13% kind of thing. If you look at the portfolio, the performance of this particular index, I think it is beating almost all expectations. If you have rational expectations, there should not be any problem in beating those expectations. So now what we have done, we have compared this particular index with these mutual funds, particularly the large mutual funds or big large cap mutual funds. So we have compared them. So in 1 year category, you can see that NV20 index is beating all these top quartile kind of large cap funds. Aditya Birla Frontline has given minus 2.42% returns. ICICI Blue Chip has given minus 1% return. SBI Blue Chip has given minus 3.70%, and HDFC Top 100 has given minus 1.12%. So NV20 has given 11.62%. So clear outperformance. This clear outperformance is there because of the technology allocation. It is not that it was an intentional allocation this particular index has taken. They have specified some rules. So that particular algorithm was suggesting them to have allocations towards technology stocks because of the attractive valuation, and that's why they have done that. And that is the main reason why we are seeing 1 year returns, this phenomenal outperformance of for last 1 year we are seeing. In 3 year returns also, you can see that NV20 is at 14.84% per annum, vis-a-vis Aditya Birla Sun Life Frontline is at 10%. Then ICICI Blue Chip has 11%, SBI Blue Chip has 9%, and HDFC Top 100 at 11.42%. So here also the outperformance is clear. Though in 5-year category, 5-year returns category, NV20 is little underperforming, but not by very much high margins, like hardly 1% kind of underperformance is there. So NV20 is at 14% and all these other funds are at 15%. But if you look at the returns since 1st Jan 2009, NV20 has outperformed almost all funds by close to 2 to 3%. NV20 has given 20% per annum returns for almost last 9.5 years. Vis-a-vis Aditya Birla Sun Life Frontline has given 17.52% returns. ICICI Blue Chip is 18.64%. SBI Blue Chip 17.07% and HDFC Top 100 17.23%. So if we look at the comparison, I think with the low expense ratio, as we have made a video on whether you should invest into index funds or not. So in that particular video also you will be able to see that the idea, what we tried to explain was, in large cap category you have some options available for index funds or ETFs, where because of this new SEBI guidelines of TRI index, this large cap category funds could be beaten by these kind of index funds or ETFs. So you should always have these funds on your radar for investment. We feel that going forward, particularly in large cap space, index funds and ETFs are going to take the big market share from these actively managed funds. But in small, mid and multi-cap kind of category, we still feel that your actively managed funds will outscore because of the flexibility they are having. In large cap category, because of the new SEBI guidelines, large cap funds cannot have allocations to small and mid cap for outperformance, because minimum 85% allocation should go to large cap stocks. So in this phase, if your investment horizon is 5 years, you should definitely look at this NV20 index. So what are the options available for investment if you want to invest in this NV20 Nifty value 20 kind of index? So there are 3 options available currently: Reliance ETF NV20, Kotak NV20 ETF and ICICI Prudential NV20 ETF. These ETFs are almost replicating the returns of the index. Now it is up to the expense ratio. If the expense ratio is on a lower side, definitely I think you should look at those kind of funds. So in the Reliance ETF NV20, expense ratio is 0.16%. This ETF was launched in June 2015. The current assets under management are 19 crore rupees. Though the assets under management are on a lower side, but hopefully over the coming months or quarters or years, slowly the assets under management will keep on increasing. So Kotak NV20 ETF, the expense ratio is only 0.05%. So quite attractive expense ratio. Launch date is November 2015. Assets under management are hardly 4 crore rupees. And the third, this ICICI Pru NV20 ETF was launched in June 2016. Currently, the expense ratio is on a higher side, 0.45%, and assets under management are hardly 3 crore rupees. So, I think over the coming periods, hopefully the assets under management will increase and it will be a very good competition for your actively managed funds. So friends, we hope that you would have found this video important, and that is why we have made this video for our channel members. So these kind of different kind of analytical videos we are going to make for our channel members. So stay tuned to our YouTube channel, and until next video, happy investing friends. Jai Hind.